My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you make money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Do we dump stocks wholesale? Just get rid of them? Sell. Now that President Biden's proposed a huge increase in the capital gains tax for the wealthy? That's certainly what a lot of people did today, with the Dow losing 321 points. S&P sinking 0.92%. NASDAQ falling 0.94%.
House of Pain.
Almost all of the decline occurring when news broke of the potentially huge change in the investment firmament. Now, we know the current 20% capital gains rate has drawn a great deal of money into the stock market. We can't deny that when George W. Bush cut the capital gains rate, it was an immense windfall for the wealthy. Never sat right with me that we're taxing investment income at the lower rate than your paycheck. But as my old colleague Larry Kudlow would argue endlessly on our old show, Kudlow and Cramer, that lower rate would spur investment by the rich, who might otherwise park their money in something that doesn't generate jobs, like muni bonds. That was back during Bush's first term, long before Larry became Donald Trump's chief economic advisor. Oh, he wanted a capital gains cut. I argued that they should cut the dividend tax rate. Dividends are taxed much higher. Instead, giving people more incentive to own stocks rather than trading in and out of them. I thought it was one or the other. But the Bush administration never met a tax cut that didn't like. So they gave us both. Now, if Biden manages to jack up the capital gains rate, plenty of people will try to take profits. But you know what? Let's explain something right now. There are two major problems with that strategy. First, they can simply make the tax hikes retroactive, so there's no escape. But second, and I think much more important, let's get our heads around this right now. It still needs to pass Congress, and I'm betting Biden doesn't have the votes in the Senate. Listen, I can live with taxing capital gains as ordinary income. We don't want higher taxes, but I can live with it. But the idea that Biden has 50 senators who will vote for this is just fanciful, frankly. Obama had a supermajority, and he only raised the capital gains rate from 15% to 20%. Still, I think, you know what? Let's use this as a teaching moment so we get on the same page together. This feels like a good time to talk about some key investing rules that I don't emphasize enough, especially now that so many people have huge gains in situations that seem increasingly perilous and might make rash decisions until the situation has more clarity. Now, one of my oldest rules from my days of helping wealthy individuals at Goldman Sachs before I had a hedge fund is pretty controversial. Don't fear the reaper, by which I mean the tax man. See, I don't care if the capital gains rate is 44% or 20%. If you're more worried about your tax bill than you are about the fundamentals of your companies you own, you could end up losing a lot more money than you'd ever pay Uncle Sam. My richest clients absolutely never wanted to hear this. See, they hated paying taxes so badly. They wouldn't care if the business had turned down. They'd hold technology stocks that would shoot up in price, only to see them destroyed as newer, better technologies took over. I remember trying to get people out of Bunch, the old acronym for Burroughs, Univac, NCR, Control Data, and Honeywell. These were the mainframe companies that competed hopelessly against IBM. At one point, they were all hot as a pistol, the FAANG of the early 80s. But then smaller computers came along, and their stocks just fell apart. While they survived in one form or another, you had to sell their stocks when mini computers took over. Then you had to sell the mini computer names like Data General and Digital Equipment when those were eclipsed by microcomputers, which in turn got beaten by the PC. We have Intel on the show tonight. Intel helped destroy the tech titans of the 80s because their chips made it possible for smaller machines like this, okay? This is more powerful than a mainframe in those days. Now, I mention all these things because I watched helplessly as people just... they let their stocks go down the drain because they refused to ring the register. They didn't want to pay the taxes. In the end, they avoided the tax man all right entirely, though, because their gains evaporated. Their stubbornness, it impressed me, but not in a good way. If the fundamentals are deteriorating, people, you need to forget about the tax bill and sell the darn stock. That reminds me of another rule that feels real applicable right now. It doesn't matter where a stock's coming from. It only matters where it's going to. I don't care what you paid for it. You have to figure out what you want to do with it right now, and your cost basis has nothing to do with that decision. Get emotionless, people. So what kind of stock should be sold, regardless of what it means for your tax bill? Well, ask yourself if the company you own shares in might be facing an existential crisis. Many are. If that's the case, maybe it's a so-so retailer in a series of so-so malls, or because it's got no prospect of earnings anytime soon and it's running out of money. Maybe it's a SPAC that has no hope. You should be a seller regardless of what happens with the tax code. Similarly, though, if you've been waiting for a viable pullback, now get this. This is a completely motivated by taxes sell-off, not by the fundamentals. So what are you getting if you have cash? You're getting a terrific buying opportunity right now. All sorts of stocks are being hammered off this presumption of tax hike. We don't know whether or not Biden will succeed, but we do know these are the same companies they were yesterday, right? As I always tell members of the ActionAlertsPlus.com club, this is one of those moments where you need to have that shopping list at the ready, all those levels, so you can pull the trigger. Because stocks are being put on sale, not because of the fundamentals of the company. The trust bought some stock today for the first time in ages. It's yet another reason why I'm constantly saying you should keep a little cash on the sidelines, why you need to take a little, well, we used to call it a schnitzel, a little bit of profit, so you have some money just in case some exogenous threat pushes down the market without damaging the actual businesses of the stocks people are selling. And that is what is happening. Finally, remember, we're not hearing anything about a dividend tax hike, right? I didn't. Did you? This morning, we heard from the CEO of ATT on Squawk Box, CEO of Dow Chemical on Squawk on the Street. Both delivered excellent earnings with very strong forecasts that won't be impacted by a change in individual tax rates. But if you truly believe Biden will make the capital gains rate equal to ordinary income, then maybe you should want non-ordinary dividend income, taxed much lower, more valuable than ever. And that means ATT with its bountiful 6.6% yield, now backed up by the cash flow, and Dow Chemical with its 4.6% yield should both, well, let's just say they're worth a lot more today than they were yesterday. Now, these changes to the tax code will make companies with good dividends more enticing, even as many of them got hit today. Remember, the companies aren't worth more, but their stocks are. So even though I think this capital gains hike is highly unlikely, it's always important to be ready for anything. If you want to take advantage of this tax-motivated decline, don't do it all at once, though. Assuming Biden doesn't make the hike retroactive, there could be days of selling pressure here. And you don't want to catch the first wave that just started in the afternoon. But the bottom line, please do not fear the tax man. Don't fixate on where a stock came from. Only think about where it might be going. Most important, be ready to buy stocks that are getting crushed by tax fears that have nothing to do with the fundamentals. And watch for stocks with good yields if you're desperate for tax-efficient income. You should view this sell-off as an opportunity, not a penalty. And please remember that most people who own stocks hold them in tax-favored retirement accounts that will be totally unaffected by this stuff and have no need to sell anyway.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.